A lot of homeowners are making a huge mistake right now. They're waiting on the Fed to lower the Fed funds rate, thinking that's going to lead to lower mortgage rates. And here's the thing, the last time the Fed cut rates, mortgage rates jumped almost immediately afterward. And the reality is that could happen again. And if it does, you could miss your opportunity to refinance and possibly save thousands. In this video, I'm going to show you exactly how to know if you should refinance, as well as what to watch out for when talking to mortgage brokers going through the refinancing process. Last September, I was able to refinance my mortgage from a 6.5% down to a 6% when interest rates dropped. Now the reality is I could have waited for the Fed to cut rates hoping that interest rates would go even lower, but it was going to save me around $500 per month. So instead of trying to time the perfect opportunity, I took advantage of that $500 in savings, refinanced my loan with a no-cost refinance, so no money out of pocket, and fortunately was able to lock in that interest rate. Well, shortly after, interest rates climbed about 1%. So had I waited for even lower rates, I would have missed that opportunity. In fact, I would still be waiting today because interest rates haven't reached that point in the last year. But here's the good news. We started 2025 with interest rates just over 7%. And at the time I'm making this video, interest rates on a 30-year fixed are sitting somewhere around 6.5% on a conventional loan, and even lower, around 6% on FHA and VA. But here's what I want you to take away from this video before we talk about whether or not you should actually refinance and what to watch out for, and that's that timing a refinance is very, very risky. You have to understand markets don't move linear. And with all the volatility out there at the moment between Trump, the Fed, employment data, inflation data, it's very, very possible that you could see a reversal in interest rates before you ever pull the trigger. But with that, I want to touch on something I'm hearing a lot of right now, and that's I'm going to wait until the Fed lowers the Fed funds rate because then interest rates are going to move down even lower. It's important to understand that the Fed doesn't control mortgage rates. There's something called the efficient market hypothesis, which basically means that asset prices, let's just say the 10-year note for example, fully reflects all of the available information out there. And because the Fed has come out multiple times and said that they're likely to cut interest rates 2 to 3 times for the remainder of the year, that's essentially already built into the market. In fact, that's probably one reason that we've actually seen interest rates already move down, because it's already built the anticipation of what's likely to happen with that September rate cut. And that's exactly what happened last September when the Fed did cut rates. We actually saw the market go the other direction. So the important thing to realize is that much of what the Fed has discussed is already priced into the market, and waiting for even lower rates could end up backfiring, especially if it makes sense now. Now with that, I think it's important to understand that just because interest rates drop doesn't necessarily mean you're in a position to refinance. In a lot of markets out there, home prices have moved sideways. In some markets, they've actually moved down. So if you were somebody who came in and you put a minimal down payment, or maybe you came in and put 20% down and your home price has actually decreased, well, when you go to refinance that property, there is a chance that you don't have the equity in the property that you once had, which could mean refinancing no longer makes sense, especially if you now need mortgage insurance on that property. So when you are sitting on the sidelines or sitting on the fence wondering whether or not you should refinance, it's important to understand that if you have a conventional loan, your loan to value could rise if properties go down, which could impact your ability to refinance and actually lower your mortgage payment. Now, if you have FHA or VA, there's a way to do an FHA or VA streamline where no appraisal is needed. So those are actually going to be less impacted by values moving down. But this should be part of your equation when you're sitting on the sidelines and you're looking at interest rates, and it makes sense because you're going to save a couple $100s a month and you're thinking, well, I'm just going to wait even more for rates to go even lower. Well, what if home prices drop? Does that now impact your ability to refinance? Well, that's definitely something you have to consider. Now, everything I'm going to discuss from this point forward is basically for novelty purposes. It's me giving you my opinion of what I think you have to consider, whether it makes sense to actually refinance and what to pay attention to in that process. Now, the reason I say for novelty purposes, because it's very, very important when going through this process to make sure you're talking to a professional. Don't just take what I'm saying here and run with it, call somebody on the phone and refinance your mortgage. Make sure you're talking to somebody that can walk you through this process, answer your questions, and ultimately give you the information you need to feel comfortable with that. Now, my team has helped hundreds of people here on YouTube, and we'd love the opportunity to help you too. So if you'd like to speak with our team, make sure you check that link in the description of the video. Now, the question we get all the time is, how do we actually know if it makes sense to refinance? Well, I'm going to give you something called the $125,000 formula. It's something my lenders use with countless clients over time, and it's just a basic math formula to figure out whether or not you should be having that call with a lender. Now, if this doesn't pencil out, then chances are it's probably not time to refinance. If on the other hand, it does pencil out, then that's where it makes sense to actually have that conversation. Doesn't mean it's 100% going to work. It just means you should be having that conversation to see how much money you can actually save. Now, the $125,000 formula is simply that. You take $125,000 and you divide it into your loan amount. Now, if you have a loan amount of $125,000, you divide it by $125,000, that's 1. That means you need to save 1% on your mortgage for that refinance to make sense. But let's say you have a $250,000 mortgage, then you need to save 0.5%. If you have a $500,000 mortgage, you need to save 0.25%. If you have a $1 million mortgage, you need to save around 1/8%. Now, the reason this formula doesn't always work is because sometimes there are costs to refinance your mortgage. Some lenders out there charge points. Some lenders out there charge multiple fees in order to refinance your mortgage. So just because you're saving 0.5% per month doesn't necessarily mean it's going to make sense, because if you have a bunch of closing costs associated with that mortgage, then that's ultimately going to impact your break-even point, which is something that I think is very, very important when going through that process. Is you need to understand what your break-even point is when you're refinancing your mortgage, which is essentially your loan costs divided by your monthly savings. Tells you how many months you need to recoup that cost. Let's say, for example, you're able to save $100 a month by refinancing, but it's going to cost you $5,000 in order to refinance that mortgage. Well, you take the $100, you divide it into the 5,000, which means 50 months you need in order to recoup that cost. So that's just over 4 years. Now, here's the thing. If you plan on selling that home or getting rid of that home within the next 4 years, then it probably doesn't make sense to refinance if it's going to cost you $5,000. Now, earlier in the video, I told you I was able to do a no-cost refinance last September, and that meant no money out of pocket. And the way I was able to do that is I was able to take a slightly higher rate than the best interest rate on that day, and the lender gave me a credit which covered my closing costs, so I didn't have to come up with any money out of pocket. I also didn't add anything to my loan, and I was able to refinance with the same exact loan term, and I saved almost $500 per month. So when you're refinancing, there's a couple of lender tactics and things that I want you to watch out for that's very, very important. It could impact whether or not it actually makes sense to refinance your mortgage. And what I'm talking about here is I really want you to pay attention to box A on the loan estimate. Now, when you're refinancing, the lender not only controls box A, but they control the title and escrow and the other boxes on that loan estimate as well, because a lot of times they're picking the title and escrow company. But more importantly, I want you to pay attention to box A, because that's where the lender is charging fees. They're charging points to you. Now, a lot of times they might be charging something called origination points. And other times they may be charging things like processing fee, admin fees. They may be calling it different things, but at the end of the day, anything that's on box A on your loan estimate is essentially points that you're paying for that mortgage. And one easy way to compare one lender to the next is look at box A on your loan estimate compared to box A on whatever other loan estimate and see what fees are being charged. Now, in some cases, you're being charged to buy down that interest rate. What'll happen more often than not is you call somebody online, say some sort of call center, and you get somebody online and they promise you a rate that's almost too good to be true. And what they don't tell you is that you're often paying points in order to get that rate. Now, in some cases, maybe you want to pay points. If you're at the end of your work career, you're no longer going to have a job next year, that sort of thing, and this is going to be the last time that you're able to refinance. In some cases, it makes sense to pay points. But for most people out there, the majority, it doesn't make sense to pay points, especially if you think you could see lower mortgage rates in the future. And that's because anytime you pay points on a mortgage, you essentially have a sunk cost. And say, for example, it makes sense for you to refinance today at 6.5%. Well, what if in 6-8 months interest rates move down to 6% or even 5.5%? Are you somebody that would take advantage of that lower rate at that time? Let me know in the comments. And if the answer is yes, then essentially you shouldn't want any sunk cost in that mortgage. Now, on top of that, another thing I hear all the time from call center lenders out there is that there's no out-of-pocket charges for your mortgage. Well, yes, there's no out-of-pocket charges, but there can still be charges on that loan where they are essentially rolling it into your loan balance, where your loan balance is building, if you will. Instead of coming up with money out of pocket, you're essentially taking your equity and paying those costs. And really all this is a sales tactic by that lender in order to make their loan terms seem better than they are. Now, what I'll say is there's nothing wrong with having out-of-pocket cost on a refinance. And there's nothing wrong with having no out-of-pocket cost on a refinance, as long as you understand what's going on. A lot of times, people's balances say you owe $500,000, and when you refinance, now instead of owing $500,000, you owe $510,000. You just added $10,000 to the balance of your loan, because the lender is charging you all of these fees in order to refinance your mortgage. Now, again, assuming you know that and you're okay with it, great. But a lot of people don't understand why their loan balance is going up. Well, it's going up because the lender's likely charging you fees. You're having title and escrow and all of these other fees that are associated with your mortgage. And instead of you paying them out of pocket, they're just rolling them into the loan. So just beware of lenders that use these terms. On top of that, beware of lenders that take you back into a 30-year term every single time you refinance. Now, chances are, if you're looking to refinance now, you just got your loan within the last couple of years, which probably means you haven't paid a lot of years on your loan term. But either way, if you're somebody that's looking to pay off your mortgage at some point in the future, chances are you don't want to reset that term back to a 30-year term every single time. So one way to avoid that is have your lender give you a quote based on the current term of your mortgage. If you've paid 6 months or a year on your mortgage, have them give you the exact same terms so that you can compare your savings today to exactly what you have today. A lot of lenders out there will take you back into a 30-year term to actually inflate the savings that aren't real savings, because all they're doing is taking your loan term out further into the future. So just remember, when you're comparing loan terms, you're comparing the exact same loan terms across the board so that ultimately you can make the right decision for yourself. Now, another thing I see all the time is lenders trying to get people to do cash out refinances. Now, cash out refinances are a little bit more expensive when it comes to the actual interest rate. Now, the actual cost of the refinance shouldn't really be any different on a cash out refinance, but what is different is typically you're paying a higher interest rate on a cash out refi. But in some cases, maybe that's a way for a lender to actually offer you a higher interest rate where they make more money by doing the cash out refinance option. So if you're doing a cash out refinance, just be careful that you're not rolling short-term debt into a longer loan term where you're just stretching those payments out over a longer period of time. If you have a car payment and it's only a couple of year car payment, chances are you don't want to roll that into a 30-year balance on your mortgage. Now, if you have things like high interest credit cards and things like that are continuing to grow over time and you can't get out from underneath them, then in some cases it does make sense to refinance those into your mortgage. But the important thing to understand here is exactly what you're doing. You need to know what you're doing and what the pros and cons of it are. And many lenders out there, unfortunately, can't explain that to you. Now, before we talk about some common traps that I see out there when it comes to refinancing, do me a favor and hit that thumbs up if you find any value in my videos at all. And if you want to stay updated on information like this that helps you save money, do me a favor and subscribe to the channel. Now, there's one important thing that I want you to walk away from this video with, and that's just because you're getting a lower payment doesn't necessarily mean it's a good deal. If you're paying a bunch of costs, you're resetting your loan term, all of these things, and your months to recoup is years and years out, chances are it probably doesn't make sense to refinance, even if it looks like it on a monthly basis, because all you're doing is either trading money in your equity or money out of your pocket for savings that don't really exist. That I'm seeing a lot of lenders out there at the moment tell homeowners that they're able to skip 1-2 months of mortgage payment by refinancing and they get this super low rate, so on and so forth. Understand there's no free savings. You know, the cost of lunch is never free. You're paying for it in some way or another. As I mentioned earlier, you can do a no-cost refinance like I've done in the past. Now, I'm able to do that because I took a slightly higher interest rate than the best interest rate out there in the market. So say, for example, the best interest rate today is 6.5% for my terms. If I take a 6.625 interest rate, chances are there's going to be a credit back from that lender that's going to help me cover some of my costs. Now, in some cases, maybe it covers all the costs. Now, in some cases, it doesn't cover all the costs, it's just partial cost. But the reason I'm bringing that up is because that's not a free lunch. Even though I'm not paying any cost, I'm taking a worse rate than the best rate in the market. The same thing goes when you're skipping 1 month or 2 months worth of payments. You're paying the interest on those skip payments in one form or another. So when you're going through that process and you're talking to a lender, just make sure you feel comfortable with the process. Make sure they can answer your questions. If they can't answer your questions, then chances are they're probably not the right person. You have to understand this business is an 80-20 business where 20% do 80% of that business. In fact, it's probably even skewed even more, where 10% do 90% of the business. So instead of just going on Google and typing in refinance and calling the first person that pops up, make sure you're working with a professional team that can answer your questions, guide you through the process so that ultimately you feel comfortable. Now, the reason I bring this up is because my team and I have helped a lot of people here on YouTube, and we'd love the opportunity to help you. Just make sure you use that link in the description of the video to schedule a call with our team. So just a little recap on when it actually makes sense to refinance. Remember, you want that months to recoup period as low as possible. possible, right? Within a year is probably ideal. Within 2 years, a little bit better. Anything beyond 2 years, you probably don't want to do that refinance because chances are rates are likely going to continue to move lower and you're likely going to be able to take advantage of them, assuming you have that equity in your property and all your other financial information hasn't changed. But along with that, just remember the $125,000 formula and make sure that your rate drop meet or exceeds that targeted number. And lastly, you want to make sure you're improving your loan terms, not only the interest rate, but the monthly payment, the savings. Maybe in some cases you're getting rid of PMI or you're paying off debt. Overall, you want to look at that total savings amount and divide it into the cost that it's costing you to do that loan in order to figure out how many months it's going to take you to recoup. Remember, the right time to refinance is not about the headlines. It's about your numbers and your timeline. But this is where I want to ask you a question. Interest rates today are at 6.5%. If you're in a position to refinance today, are you moving forward or are you waiting for even lower rates? Do me a favor and let me know in the comments. Now, if you're somebody that thinks you are going to refinance, you don't really understand the process, you kind of want the basics of what it means to refinance and what that process looks like, do me a favor and check out this video here.